Welcome to the Global Equity Valuation Competition. My name is Andrew Stotz, and I'll be your host. And today, the next one we're going to hear is Vivan, who's going to be presenting Delhivery. Ooh, interesting. So remember that the Global Equity Valuation Competition is sponsored by Valuation Masterclass and Koifin, who provides tools for our contestants. Vivan, are you feeling ready?
Yes, Andrew.
Yeah, so let me bring your presentation up. Now we've got your presentation on the screen, and so I'm going to leave, and then as soon as I leave, then you can start, okay?
Okay.
All right, I'm leaving now, so you can start now.
Okay. Good evening, everyone. My name is Vivan, and I'll be presenting my initiating coverage on Delhivery. Delhivery is India's largest third-party integrated logistics service provider. It was and 2022. Delivery operates across five major segments. First is express parcel for e-commerce, part truckload and full truckload for commercial freight, cross-border logistics, and it also provides supply chain services. I initiate a coverage with a buy recommendation based on my DCF derived target price of 587.19 rupees, which is almost a 27% upside from its current market price of 462.70 rupees. My WACC is 13.1% and the terminal growth rate is 5.38%. My valuation is based on a forecasted revenue of CAGR of around 13% revenue growth. Now, if we look at the stock's performance since its listing, Delivery has largely underperformed its benchmark, the Nifty 50. I believe the biggest reason behind this is the market's concern around its profitability. For several years, the company focused heavily on expansion. It built hubs, networks, it integrated acquisitions, which kept the earnings under pressure. However, in FY25, it marked Delivery's first ever year of PAT positivity, which I believe the company is now entering a different phase where the earlier investments are translating into its earnings growth. Now, moving to the next slide, the first thesis is the Indian logistics market itself. India's logistics market is estimated to be valued at around $240 billion. But a large part of the industry, almost 55%, still remains fragmented and is controlled mainly by regional operators. I believe this creates a long-term consolidation opportunity for scale and organized players like Delivery, because logistics today is increasingly becoming more tech-focused and more scale-oriented. While there are many different logistics players, uh, but they mainly work in specific segments. Uh, but on the other hand, Delivery has built an integrated logistics service platform across its revenue segments. Coming to the next important pillar, it is the Ecom Express acquisition. In April of 2025, Delivery had acquired Ecom Express from uh, at a price of 1407 CR, which was an 80% discount from its peak valuation. I believe this acquisition was strategically important for Delivery because Ecom Express was once Delivery's biggest competitor in the e-commerce logistics platform. The acquisition has strengthened Delivery's market position and has accelerated its shipment volumes. As you can see in the revenue breakdown, Express Parcel forms almost 60% of Delivery's revenue. And this paid off as it is visible in Delivery's recent quarter performance, where its shipment volume crossed 43% year on year, with reaching to nearly 295 million shipments. Now, coming to the last and probably the most important pillar, it is the PTL growth story. Earlier, the PTL business was considered a weaker segment after it had acquired Spot on Logistics in 2021, mainly due to lower margins and constant integration pressures. However, I believe the business has now improved significantly. The PTL tonnage, which is the weight of shipments carried by the trucks, has crossed 500,000 metric tons for the very first time in Q3 of FY26, which is a 23% year-on-year growth. While the transport service EBITDA, which is the express parcel plus the PTL transport EBITDA, has crossed 16.4%, the highest ever in the company's history. I believe that PTL is now becoming an increasingly important part of delivery's growth story because it helps delivery clean out its profitability profile, and it reduces delivery's over dependence on the e-commerce logistics. Now, moving on to the last segment. For several years, the market viewed delivery as a company which had low margins and which showed significant growth, but always struggled to convert that growth into profitability. However, in recent quarters, as you can see, uh, uh, the business is now beginning to scale even profitably. In Q4 of FY26, the results came out 3 days back. The revenues have grown 30% year on year, while the EBITDA has grown significantly faster. I think this is important because it consistently shows that profitability is now improving faster than the growth. At the same time, the PTL freight volumes have continued scaling strongly, and while the express parcel volumes has crossed 1 billion shipments for FY26, which is even more than I had expected in my model. I believe delivery is now entering a phase where earlier investments in infrastructure and transportation routes, their acquisitions, and their investments in networks have begun to generate a leverage, which allows margins to continuously improve as the volume of shipments increase. Although there are certain risks around delivery, majorly the e-commerce over reliance, its its major and its competition on the low barrier segments like hyperlocal and last mile delivery. I still believe the company is gradually transitioning from a scale building phase to a more profitability driven phase.
All right,
In the end,
time's up. Time's up.
okay.
Okay. So, one of the questions that I have on this is, you know, if I look at the operating margin improvement, which you're highlighting here, it looks good. And the net margin doesn't look that great.
Yes.
And part of what I'm wondering is, you've told a pretty amazing growth story about this company. How much more does it have to grow to hit economies of scale where it's really generating significant, profits? Or is 7.5 on the operating margin the best that they're going to get to?
Currently, as I have seen the market, the the mature competitors as compared to delivery, they consolidate at early teens, mid teens of operating margin. So there is still a long way to go for delivery. And as in the management guidance in the con call a few days back, they had uh, they had told everyone that they are still feeling that the operating margins will increase. And as I had talked previously in the market, talking about the market overall, the there is still significant room because India's logistics sector is still largely unorganized, and there is still a large market to capture. So I believe the operating margin will still continue to improve.
Okay. And can you go up to the first page?
Yes.
All right. Uh, what do you expect for revenue growth, let's say on average over the next 3 to 5 years or so?
On an average, I expect the revenues to grow by almost 13% CAGR, as I had incorporated in my model, where I took basically the volumes growth, because in this segment, the realization, which is per shipment cost, almost remains the same, and it tends to remain sticky, which means that their customers don't want to even lower the prices, because it is largely a service business, and I think it helps them also. It helps delivery also, and also their customers. And the revenue is basically uh, driven by the volumes growth, and the volumes have grown significantly over the past year.
And what's the risk? I would say that let's say the average EBIT margin in the world is maybe about 10%. And you've already mentioned about that, something similar to that, to more successful peers. They're at 7.5. And what's the risk? Let's just say they can't get that up as fast as possible. And what you also show was depreciation rising. And I suspect, CapEx and working capital needs are strong. Is there any risk that this company just can't deliver free cash flow to the, strong key free cash flow that's growing fast? Or do you think that no, it's at the point where that free cash flow is going to start to fly?
Yes, I think it's a really good question. Like in the recent quarter four earnings call, they have shown that they have now for the first time turned operating cash flow positive. So now I believe that the network, the investment, the expansion has truly set in, and now delivery is at an inflection point where their uh, cash flows are just about to increase at a very normalized level, and it will
Okay.
be normal for the next few years.
Okay. How does it feel to complete this round of the competition?
It really feels amazing. It was a really great opportunity by you and everyone at the Eastwards Academy. They were really lovely.
Yeah, it's we trying to provide you guys a good experience, give you as much tools as we can, and raise the pressure. And
Yes,
all of you guys have responded. So well done, well done.
thank you.
All right, I'll see you in the Slack channel, and we'll talk more there. Well done.
Yes, sure. Thank you.
So another great presentation. These are so good, and I'm learning a lot myself. That was Vivan, and he was presenting delivery. And this is the Global Equity Valuation Competition, sponsored by Valuation Masterclass and Koifin. My name is Andrew Stotz.